Portfolio Builder members, the Whale Club continues to generate those safe, easy profits. If you like to have low volatility and generate consistent returns and trade some instruments that not many people can afford to do it, Whale Club is for you. This program does require that you get at least 100 shares of Google and 100 shares of Amazon, or at least one of those companies. And then you can follow this very repetitive and simple trade alert as we go into the China trade war, which I believe will escalate by the end of this month or by July at the latest. So here was our account value last Thursday at 82,863, and we entered into a set of trades that are very similar to today's, selling a covered call, taking half the profit of the covered call and putting it into a put option. That protects us from the downside. The downside part of the trade didn't pay off today, so we only made money after you subtract everything that we spent to get into the trade. We're trying to get a 0.5% return consistently. So if you think about it, that's a 28% annual return if you can make a safe 0.5% every week. Now, I'm not saying we can do that, but even if we do half of that, it's still a great return, especially when you see the safety of these trades. So now we're at a $87,804 profit, and we're going to repeat the exact setup as last week. Now, if you do have enough capital, you might want to consider following the Apple trades on Tuesday and then the Google Amazon trades on Thursday. That'll diversify your portfolio a great deal versus being only in on Apple or only in on the Google and Amazon. Also, the potential profit for these portfolios is far greater than trading the SPY. The SPY is so safe that the covered call income is much less, so you can't afford to get as much downside protection as you can when we're trading these ones. So let's just take a look. Step one, you need to own 100 shares of both of these two assets, or at least one. You could follow with just one of these stocks and have very similar results. You just won't be as well diversified. So that's step one. Now, if you are just beginning these trades today, you can skip step two because you don't need to close out the covered calls or put options we did the last week. So if you did follow last week's trade, let's just look at what you would do today. You've either been assigned, and in that case, you have the profit, your shares were purchased from you, you're in cash. All you need to do is now sell out your put option. So that's to sell to close the June 21st, 2019, 1005 put option. So we lost everything on that pretty much. And you really don't need to sell it unless you want to. If you want to hang on to it and see if it jumps in value before it expires on the 21st, you have nothing to lose at this point. We already realized the maximum profit. If you just want to get it out of your hair so you don't have to have it kind of fogging up your view of your trades, then close it out. Next step is to do the same thing on our Amazon positions. Now, most likely you were assigned, you got the maximum profit, you're in cash, so you have to buy back those shares. If not, you make the same profit. It's all just relative to the current trading prices in terms of what we have to pay to cover this covered call. So buy to close the June 14, 2019, 1720 call option, and then sell to close your June 21st, 2019, 1655 put option. Again, we hit the maximum profit on both these trades if the market were to go up. So that's great. We can make a little extra if the market goes flat or down with this setup. Okay, moving along to the new setups. So once again, we're going for about a 0.5% return. This Amazon trade's a little bit more lucrative at 0.59, and the Google trade you'll see is about 0.48. But all in all, it's around a 0.5% profit if we go higher or flat. And if we go lower, we could potentially get a much bigger return than just 0.5. So we're set up to profit extra if the market goes really low. But if we go flat or higher, this is the type of return we're looking to generate. So we have a huge safety net, and we're generating a great return that really adds up over time. Now, real quick, I just want to show you on both these trades how I pick the strike for the covered call. I look at the put option market. So here's where Amazon has support. 2,000 contracts will currently be forced to purchase Amazon if it travels to 1860. And so that's where we sold on the opposite side of the option chain, the covered call. So that's where we're willing to sell and they're willing to buy. So it makes sense, doesn't it? Now we're giving up about a $750 loss on the underlying to pick up $33 in income. So that's a great deal. We lose 7 against our shares, but we get 30 if it goes higher. So that's a great deal. And we have protection to this $1860 level to some degree with the covered call. Now, really, the big defense is reinvesting around half of that profit into this longer duration put option. So that's how we can actually get more money if the market goes lower quickly before this covered call goes to expiration and before our put option goes to expiration. So on the Amazon side, the trade is to sell to open the June 21st, 2019 1860 call option for a credit. Don't worry about what credit I got. It's all relative to where Amazon's trading right when you enter the trade, and it will be a very fair price. So the important part is the expiration, the strike, and whether it's a call or put, and the side. So sell to open June 21st, 2019 1860 call option. It's part 1. And then part 2, add protection. Take half your profit, buy to open the June 28, 2019 1790 put option. That's going to cost around $11.78 times 100. So you're giving back a lot of the credit to add downside protection. The Google trade is slightly less profitable because there's less volatility in its underlying asset. The Wall Street bet on the put option side is at 1080, so that's where we're writing our covered call. And again, we're putting half the profit into a put option. Sell to open the June 21st 1080 call option for $20.75 credit. Again, the credit may be different for you. What's important is sell to open June 21st 1080 call option. Part 2, buy to open the June 28th 2019 1040 put option. So it's the same thing. We're taking half the profit and adding some downside protection. Now I do want to point out that you can save a lot of money and take advantage of the little link in your email. It's for $49.97. One-time payment will refund anything you've paid in the past, and you're going to get all of my content for the rest of your life. It's a one-time payment, and think about it. The Diamond program is normally $5,000 a year just on its own. The Whale Club's normally $10,000 a year. And our basic program, the price is raising to $2,000 a year. So it really makes a lot of sense to upgrade as soon as you can. You're going to get your $897 refunded right back to you that you've paid initially, and then you're set. So thanks again for your time, and look for an update later this evening where I'll review all 3 portfolios: the basic, the diamond, and the whale. So thanks again. Talk to you soon.